The sustainable distribution outperforms other 401k distribution strategies. For the past 40 years, it has provided higher initial distributions and more stable long-term distributions. It accomplishes this exceptional result by adjusting for both inflation and investment performance on a regular basis. The 2025 Q1 sustainable distribution rate is 5.13% per year or 0.427% per month based on the March 31, 2025 investment balance. This slide illustrates the distribution strategy starting in 1990. The chart on the left shows inflation-adjusted income. The 4% plus inflation strategy, which is the blue line, provided a starting income of $3,300 a month. This remained level for 5 years, which is really good. Then at age 70, RMDs caused the distributions to increase and become more variable if you follow the blue line through the rest of the time. This strategy provided the lowest starting income and the highest ending balance. My personal objective is to have more income during the early active years of retirement. The sustainable distribution shown by the green line was the best strategy for me starting in 1990. Starting income was $6,300 a month and always stayed above the starting income of the other 3 strategies. The other 2 distribution strategies provided income in between the 4% plus inflation, the blue line, and the sustainable distribution shown by the green line. On the right chart, all the distributions have sufficient balances to continue distributions for at least 40 years when starting in 1990. This slide illustrates the distribution strategy starting in 1995. Results are similar to distribution starting in 1990. The 4% plus inflation strategy, the blue line, provided a starting income of $3,300 a month. This remained level for 5 years, which is really good. Then at 70, there was an RMD surprise that caused distributions to increase dramatically and become more variable. This strategy provided the lowest starting income and the highest ending balance. The sustainable distribution, which is shown by the green line, was the best strategy for me starting in 1995. Starting income was $6,300 a month and always remained above the starting income of the other 3 strategies. The 2 other distribution strategies provided income in between the 4% plus inflation and the sustainable distributions. All distributions have sufficient balances, shown on the right chart, to continue distributions for at least 40 years. Distributions starting in 2000 are shown on this slide. Results are very different than distributions starting in 1990 and 1995. This is the scenario that retirement planners worry about. Shortly after starting retirement distributions, the stock market suffers significant and prolonged decline. In this case, it was the dot-com bust followed by the financial crisis and Great Recession. The 4% plus inflation strategy, which is the blue line, provided a starting income of $3,300 a month. Inflation-adjusted income remained level for 25 years, which is extraordinary. RMDs never had an impact because they were always lower than the 4% plus inflation distribution rate. This strategy will likely run out of money after about 31 years. This is sufficient for most retirees, except for those that retired early and lived long. The sustainable distribution, the green line, was the second best strategy starting in 2000. Starting income was $2,900 a month, which then decreased a modest 10% due to investment declines. This strategy provided lower income but retained a higher balance and will likely continue distributions for 40 years after the 2000 start date. The other two distributions started with $4,200 a month, which was really nice, but suffered more than 50% increase in income due to investment declines. These two strategies had unstable income, but retained higher balances and will likely continue distribution for 40 years after the 2000 start date. This slide illustrates the distribution strategy starting in 2005. Results are considerably better than distribution starting in 2000, but not as good as 1990 and 1995. The 4% plus inflation strategy, the blue line, provided a starting income of $3,300 a month. This remained level for 9 years, which is really good. Then at age 74, RMDs caused distributions to increase and become more variable. This strategy provided the lowest starting income and the highest ending balance. The sustainable distribution green line was the best strategy for me starting in 2005. Starting income was $4,900 a month. Income decreased a modest 12%, but always remained above the starting income of the other three strategies. The other two distributions started with $4,200 a month, but suffered decreases of 25 to 50% due to the 2008 financial crisis and Great Recession. All strategies have sufficient balances to continue distributions in the future. This slide illustrates the distribution strategy starting in 2010. Results are extremely good due to robust growth of the S&P 500 after the 2008 financial crisis and Great Recession. The 4% plus inflation strategy, the blue line, provided a starting income of $3,300 a month. This remained level for 5 years, which is really good. Then at age 70, RMDs caused distributions to increase significantly and become more variable. This strategy provided the lowest starting income and the highest ending balance. The sustainable distribution, green line, was the best strategy for me starting in 2010. Starting income was $7,500 a month. Income decreased a modest 8%, but always remained above the starting income of the other three strategies. The two other distribution strategies started with $4,200 a month and generally had increasing income. All strategies have sufficient balances to continue distributions in the future. For me, the sustainable distribution strategy performed the best overall. Typically, it had the highest distributions during the early active years of retirement, which is what I want. It also maintained sufficient investment balance to continue future distributions. The 5% plus guardrail strategy typically performed second best. Distribution started higher than 4% plus inflation, but decreased significantly during the dot-com bust and recession. The 4% plus inflation strategy performed third best overall, but really performed well when started in 2000. Typically, it had lower distributions during the early active years of retirement. The constant 5% is the easiest strategy to use, but that had the highest variability in distributions. Depending on your situation and objectives, you may have a different ranking. Each of the strategies shown has valid reasons for use. This table shows the distribution rate for each distribution strategy starting in 2024 based on 2023 year-end investment balance. I will be updating the 2025 distribution rates in Q1 of 2025. Time will tell which of these is the best distribution strategy for the future, but I believe that distribution strategies that worked well in the past are likely to work well in the future. I hope that this presentation was helpful. I would appreciate feedback regarding how to make it more useful. Regards, Doug Olson. Hello, my name is Doug Olson. Today I want to talk to you about distribution strategies for your 401k. I am a do-it-yourself investor and a bit of a financial nerd. I started investing in my 401k in 1983 and gradually became a 401k millionaire. Before I retired, I applied my financial skills to analyzing distribution strategies and ultimately developed a new strategy. A solid distribution strategy is important to me because this is my primary income during retirement. If I distribute too much too early, I may run out of money later in retirement. If I distribute too little, I will constrain my active lifestyle and leave the bulk of my wealth to my heirs. Leaving wealth to my heirs is better than running out of money, but it is not really my objective. Ideally, I want to have relatively stable, high income throughout my retirement. To analyze different distribution strategies, I created a database with historic data. I then created charts to illustrate inflation-adjusted income for different distribution strategies. This presentation shows the results of my analysis. Although future investment performance is unknowable, I believe that distribution strategies that worked well in the past are likely to work well again in the future. Let's briefly discuss longevity. We don't know how long each of us will live, but for a couple that is 65 years old, there's a 10% probability that at least one of them will live to age 97, and 1% chance that one of them will live to age 102. Wow. Considering the combination of early retirement and potential long life, I want my distribution strategy to provide stable income for at least 40 years. Since starting my 401k in 1983, I have invested in various asset classes, including conservative, balanced, and aggressive funds. My 401k is currently invested in an S&P 500 index fund and will continue for the foreseeable future. This chart shows the S&P 500 price trend since 1985, including significant stock market events, including the 1987 Black Monday, 2000's dot-com bubble and bust, the 2008 financial crisis and Great Recession, the 2020 COVID-19 recession, and the 2021 everything bubble. Despite the volatility, the S&P 500 investment outperforms other asset classes most of the time. Although the volatility is disconcerting at times, I like the long-term performance of this investment compared to other asset classes. I'm not recommending any specific investment strategy for you. This analysis and presentation is based on the S&P 500 investment data and deals with distributions from similar investments. If you are not invested in the S&P 500 or similar fund, do not try to draw any conclusions from this analysis. This presentation covers 4 distribution strategies. I actually analyzed 8 strategies, but only included the top 4 in this presentation. The constant 5% is a very simple distribution strategy. Each year, 5% of the prior year ending balance is distributed. The most popular distribution strategy is 4% plus inflation, as defined by William Bengen in 1994. This conservative strategy starts by distributing 4% of the investment balance in the first year of retirement. Subsequent year distributions are increased by the inflation rate. This provides level inflation-adjusted distributions unless investment performance and RMD force higher distributions. Bengen's rigorous analysis found that a distribution rate of 4% in the first year of retirement, followed by annual increases for inflation, provided at least 30 years of distributions between 1926 and 1976. In 2006, Jonathan Guyton and William Klinger published a new distribution strategy that adjusts for inflation, but also has guardrails to increase distributions when investment performance is good and decrease distributions when investment performance is poor. I call this distribution 5% plus guardrails. The intent of this strategy is to start at a higher distribution rate and then adjust distributions based on future investment performance and inflation to achieve at least 40 years of distributions. There are several variations of this strategy that typically have an initial distribution of 4 to 6% and various guardrail and adjustment percentages. The sustainable distribution is the top-ranked distribution strategy based on my analysis. I created this strategy to start with a moderate distribution and then gradually adjust based on future economic factors. The annual distribution rate is calculated using a database with 50 years of economic data. Each year has a different distribution rate based on analysis of the economic data. The database that I created is moderately complex with several interlinked tables and approximately 100,000 cells of data and calculations. This data is updated monthly. The calculated sustainable distribution rate can be used by anyone that is taking distributions from an S&P 500 fund. My analysis uses real, not hypothetical, historic data. In each scenario, I assume that I retired at age 65 with $1 million invested in the S&P 500 in a tax-deferred account such as a 401k, IRA, or 403b. For each scenario, I start with a balance of $1 million and then calculate the inflation-adjusted distribution and investment balance based on each distribution strategy. Inflation-adjusted distribution is plotted on a chart to illustrate and compare various distribution strategies. My final slide is my disclaimer. The content of this presentation is for informational purposes only. You should not construe any information provided as legal, tax, investment, financial, or other advice. There are risks associated with financial decisions, including loss of principal. The creator of this presentation will not be held liable for decisions others make.